Good afternoon, ladies and gentlemen, and welcome to the WAPIC Insurance PLC's full year 2018 Investors Analyst Conference Call. My name is Bode Ojeni, Executive Director of Sales and Distribution, and I'm being joined today by Mrs. Yinka Adekoya, Managing Director of WAPIC Insurance PLC, Mr. Adedayaro Ojolu, Managing Director of WAPIC Insurance Ghana Limited, Mr. Olufemi Obaleke, Executive Director, Mr. Peter Ehime, the Chief Risk Officer and Executive Director of Technical Operations, Mr. Adewale Koko, Executive Director of Technical Operations, WAPIC Life Assurance Limited, Mr. Oluseyi Taiwo, the CFO, Mr. Olushola Ojeni, the Chief Investment Officer, and Ms. Toyin Aziz, the Head Strategy and Investor Relations. For your information, the full year results being presented at this session was published last 2 weeks in the national dailies. Also note that we'll present highlights of our Q1 2019 financial performance during this session. During this call, we will discuss our business outlook and might make forward-looking statements. These statements or comments are based on our expectations as of today. Actual events and results could differ materially due to a number of risks and uncertainties. Before we jump into the presentation, just a few housekeeping matters. We are streaming live, and as such, the presentation is shared on your desktop and laptops. At this time, we will please advise participation to be on listen-only mode. I would therefore request that you be kind enough to mute your microphones so that you can hear us clearly and such that background noise does not interfere with the audio. At such a time as the presentation is concluded, we have left ample time in the agenda for questions. Instructions for participation in the question and answer session will follow at that time. We'll also take questions that come in via the chat feature on WebEx. During the Q&A session, please limit yourself to one question and possibly one follow-up question. We'll attempt to moderate the question as seamlessly as possible. As a reminder, this conference is being recorded. I'll go straight to slide 3, which speaks to the outline of the presentation. We'll talk briefly about WAPIC and then the operating environment, the regulatory environment, and of course we'll present the financial results and the analysis thereon. And we'll also present to you the outlook and how we see the future of the rest of the year. And then we'll leave room for question and answer. I'll be taking you through the bits about WAPIC, operating environment, the regulatory environment, while Mr. Seyi Taiwo will take us through the financial results and the analysis. And I'll come back to present the outlook as we see it, and then we'll conclude. Thank you very much. Slide 4 will present just a snapshot of WAPIC Insurance as a group. WAPIC Insurance PLC currently operates as the holding company for the entire WAPIC group and is quoted on the Nigerian Stock Exchange. It has subsidiaries, 2 subsidiaries, WAPIC Life Assurance Limited and WAPIC Insurance Ghana Limited, and one associated company, Coronation Merchant Bank Limited. Total assets of the company is 30 billion naira, while asset under management is 18 billion naira. We have 13.4 billion ordinary shares of 50 kobo each in issue, and all held by about 150,000 shareholders. The company operates presently with 191 professional staff. We have regional offices in Abuja, Benin, Enugu, Ibadan, Port Harcourt, and Kano, all in Nigeria. We're listed on Nigeria Stock Exchange and also have a GDR depository bank, Bank of New York Mellon. Our market capitalization as of today is 6 billion, and our reinsurance, Munich Re, Africa Re, Waika Re, Continental Re, Nigeria Re, and Ghana Re. Our actuaries are Ernst & Young, while our auditors are PricewaterhouseCoopers. Moving on to slide 5, I'll just give a brief highlight of the operating environment for the period ended December 2018 and the Q1 2019. I'll be speaking to this from 4 points: inflation, crude oil, GDP growth, and FX rate. On inflation, headline inflation continues to rise in Q4 2018, tapering at about 11.44% in December 2018. This increase reflects higher prices of food and non-food prices. The annual inflation rate, however, edged down to about 11.25% in March 2019. The Monetary Policy Committee maintained some contraction policy stance in December 2018. However, this was eased by about 50 basis points in March 2019 to support the nation's feeble economic growth and promote economic diversification. GDP grew by 2.38% year-on-year in Q4 2018, implying an annual growth rate of about 1.93%, largely driven by growth in the non-oil sector. This followed a 1.8% expansion in the previous period and beating market expectations of a 2.1% gain. The Nigeria burning oil price declined to $53 per barrel in December 2018 on the back of a decrease in fuel demand. This was below Nigeria's $60 per barrel budget reference price. The key indicator, however, edged up in the first quarter of 2019. And on FX, Naira at the parallel market gained about 3.32 Naira to the dollar, and this was due to sustained high volume of FX supply across the various windows. Naira at the interbank during the quarter appreciated by 5 kobo to the dollar based on improved liquidity. Moving on to slide 6, speaking to the regulatory and industrial environment. The National Insurance Commission, NICOM, ordered insurance companies in the country to fully adopt IFRS 9 for the reporting of the 2018 financial year and to train their respective board of directors and senior management staff on IFRS 9 accounting standards as the industry transits to the new accounting standard of reporting. This development led to the delay in the approval and release of the 2018 results by most companies. This also forced NICOM to obtain approval from SEC to extend the time for release of the results of quoted insurance companies on the stock exchange. The Central Bank of Nigeria reversed its stance on MPR at the last MPC meeting held in March 2019. The rate was reduced to 13.5% on consideration of a new focus to spur economic growth. The committee felt there was a need to signal a new direction that is pro-growth, given the relative stability in the key macroeconomic variables. The National Insurance Commission heightened its regulatory oversight to ensure that insurance companies take up only business that they have the capacity to undertake. The Commissioner for Insurance, Alhaji Mohammed Kari, noted that the move is part of efforts to protect shareholders' investments in insurance companies. Also, the Securities and Exchange Commission is considering amendments to capital market rules and regulations that will empower it to suspend any public company that fails to submit its annual report within the stipulated deadline. The draft rule will also empower the Commission to impose any other sanction as it deems fit. SEC also says it will in 2019 review the 10-year capital market master plan to meet the current macroeconomic realities in the country. This was part of a statement made by the Acting Director General of SEC, Mrs. Mary Odok, at the last post-CMC press briefing in Lagos. I'll now hand you over to Mr. Sheyi Taiwo, the CFO, to take us through the financial highlights of the 2018 results for the group. Sheyi.
Thank you, Bode. Good afternoon. My name is Olusheyi Taiwo. I'll be taking the section on the financial analysis of WAPIC Insurance PLC for full year 2018 and also for Q1 2019. The outline of my presentations will go as does: financial highlights, income statement review, statement of financial position review, and asset under management. Moving on to slide 8, that looks at the group financial highlights. This will be looked at from two areas, the earnings and also the financial position. Our total income for WAPI Group grew by 22% at the end of 2018 financial year when compared to 2017. We closed the period with total income of 16.5 billion. We had a 42% growth on our gross written premium, closing the period at 13.9 billion. Our total underwriting profit grew by 40% from 1.5 billion in 2017 to 2.1 billion at the end of 2018. Total net investment and other income declined by 41%, closing at 1.8 billion compared to 3.1 billion in 2017. Our OPEX margin ratio came down to 36% compared to 45% we closed with in 2017, while we had an improved net claims ratio of 45% at the end of 2018 compared to 54% at the end of 2017. Our total assets grew by 6% at the end of 2018 compared to 2017, while we had a slight decline of 5% on our shareholders' funds. Moving on to slide 10, the income statement review. The group recorded a commendable growth in its premiums at 42% year-on-year to close at 13.89 billion at the end of 2018 financial year. Our reinsurance expense increased in line with the growth in our GWP for the period, our gross written premium. The percentage change was largely driven by the increases in facultative reinsurance outward, particularly in the big ticket engineering and oil and energy portfolios. The increased claims recoveries for the period further dampened the overall impact of the claims payout experienced during the period, leading to the flat growth in the net claims expense. Our underwriting profit grew by 40% to close at 2.1 billion at the end of the period. The annual growth was largely driven by a growth in premiums and also better claims management. The strategic drive for improved top-line performance and better market positioning were contributors to the 11% growth experienced in our operating expense. Our profit before tax dropped to 187 million, and this was mainly impacted by the decrease in our net investment income and also the increase in our operating expense for the period. Slide 10 looks at the product performance. Slide 11, looks at the product performance. Engineering and energy portfolios contributed the highest to our gross written premium share for the period, contributing 27% and 18% respectively. Driven by a notable premium performance, our engineering portfolio contributed the largest share to underwriting profits among the group's products portfolio, contributing 40% to the total underwriting profit. Our oil and energy and aviation portfolio made underwriting losses following the increased claims experience on these product classes for the period. Underwriting profit margin for our fire and general accident business were the highest contributor to the underwriting profit margin, contributing 48% and 41% respectively. Slide 12, our group expenses. Under the caption of net claims expense, our net claims expense recoveries were a major contributory factor to the flat growth in our net claims experience during the year. Our net premium income grew by 20%, improving the net claims ratio, which dropped to 45% from 54% we recorded in the corresponding period. The 35% year-on-year growth experienced in our underwriting expense was largely driven by the increase in premiums in the reporting period. We would continue to optimize our efficiency and flexibility in our underwriting operations through business process automation across all our service levels. The minimal year-on-year growth recorded in the total operating expense at 11%, closing with 3.4 billion at the end of the review period, was as a result of the low growth experienced in our staff cost. Our operating expense margin ratio waned to 36% as the growth in the gross written premium cushioned the overall effect of the increased OPEX ratio. The retention of the company moved northward by 4 notches to 55% following the growth in the reinsurance expense, which closed at 5.4 billion as at the end of December 2018. We have further structured our insurance process as a means to ensure we optimize our capital and also have some capital relief. Slide 14 looks at our revenue. The group's total income growth trajectory recorded a 13% 4-year cumulative annual growth rate at the end of the period under review. Our year-on-year growth rate on total income was 22%, closing the period at 16.5 billion. Premium inflows from our large corporates was the highest contributor to the total premium inflows for the company, contributing 67%, while our financial institution contributed 12%. Our Ghana subsidiary contributed 11% to total gross written premium for the group, which was an 8% year-on-year growth from prior period. Our retail sales group has continued to be further repositioned to ensure we successfully implement a market penetration strategy. Slide 15 looks at our group profit position. The group's underwriting profit recorded a 40% year-on-year growth from 1.5 billion in 2017 to close at 2.2 billion for the period under review. Our underwriting profit margin moved slightly by 100 basis points to close on a growth rate of 15% year-on-year. Following increased underwriting and operating expenses during the period, coupled with a drop in our net investment income, the group profit before tax position dipped to 187 million in the financial period 2018. The decline in our operating profit largely impacted our return on earnings and also our return on assets for the period. I'll be moving straight to slide 17 that looks at the review of the statement of financial position. We've continued to rebalance our asset portfolio for strategic growth, and this was a major driver to the 65% increase in our cash and cash equivalents when compared to our 2017 position. The increase in our reinsurance recoverables across all our key product classes largely impacted the growth in our insurance assets for the period. The group's share of profit from our associate company, Coronation Maxims Bank, for the year led to the 6% increase in the fair value of the investment in associate for the period. Year-to-date change in insurance and investment contract liabilities for the period was 50% and 14% respectively for the period. This was driven largely by the growth in the company's pure risk and investment-linked obligations during the period. Our shareholder equity moved slightly downwards by 5% to close at 17.1 billion, largely driven and impacted by the fair value reductions on our on our security portfolios. Slide 18 is a continuation of the highlights of our financial position. The ratio of our earnings to total assets for the period reduced slightly by 5% from our position in 2017 to close 69% at the end of 2018 financial year. Our total assets grew by 6% to close at 30 billion compared to 28.6 billion at the end of 2017 financial year. Total liabilities grew by 24% from the 2017 position to close at 13.2 billion at the end of 2018 financial year. The major drivers include the growth in the company's insurance contract liabilities and also the increase on our reinsurance assets and obligations. Shareholders' funds decreased slightly by 5% to 17.1 billion at the end of the period. This was largely impacted by the mark-to-market losses on our securities portfolio. Slide 20 looks at our asset under management. Bonds had an 18% portfolio growth as a result of additional purchases during the financial year to close at 5.25 billion compared to 4.46 recorded at the end of 2017 financial year. The growth in the value of investment in associates reflects the group's post-acquisition share of profit in our associate company in line with the equity method of valuation. The 38% decline in our quoted investment was impacted by the general bearish trend in the stock market at the end in the financial year 2018. Investment property declined as a result of disposals during the period. The strategy of the group is to fully exit underperforming legacy properties with more focus on investments with higher yields. The combined effect of the mark-to-market loss on quoted equities and the decline in our treasury bills portfolio due to portfolio rebalancing to other high-yield assets cumulated in the overall decline in the total asset under management at the end of the financial year. I will now be going to slide 22, which gives a highlight of our Q1 2019 results. The highlights would also be looking at it from the two angles, the earning perspective and also the financial position perspective. Total income at the end of Q1 2019 grew by 8% when compared to the same period 2018. We also had an 8% growth on our gross written premium, closing at 4.8 billion at the end of Q1 2019 compared to 4.4 billion at the end of Q1 2018. Our underwriting profit increased by 63%, closing Q1 2019 at 1.2 billion compared to 773 million we closed with in 2018 same period. There was a decline of 12% in our net investment and other income at the end of Q1 2019 compared to the same period 2018. Our profit before tax at the end of Q1 2018 was 700 million compared to 319 million at the end of the same period 2018, 119% year-on-year growth. Our reinsurance asset, when compared to full year 2018 at the end of Q1 2019, was a 23% decline, while total asset grew by 3% at the end of Q1 2018 when compared to Q1 2019 when compared to full year 2018. Shareholders' funds also had a 3% growth closing at 17.5 billion at the end of Q1 2019 when compared to 17.1 billion we closed with at the end of the 2018 financial year. Slide 23 looks at the income statement review. The group recorded 4.8 billion gross written premium at the end of Q1 2019, representing an 8% year-on-year improvement from the same period 2018. We had an overall increase in the gross claims payout experience of 38%. This was largely recorded on the claims on the fire business during the review period. Our underwriting profit grew by 63% from prior period performance to close at 1.2 billion at the end of Q1 2019, largely driven by the growth in our premiums and also the base effect. With a stable operating expense position year-on-year, coupled with the growth in our underwriting performance, as well as our other operating income, the group's profit before tax position grew by 119% year-on-year to close at 700 million at the end of Q1 2019 compared to 319 million same period 2018. Strategic drive to improve and better positioning. We have put in place necessary cost optimization measures to ensure that our expenses stay within acceptable limits. Slide 24 looks at the review of the statement of financial position. We had a 10% increase on our cash and cash equivalents, closing the period with 3.17 billion at the end of Q1 2019 compared to full year position of 2018. Reinsurance recoverables utilized during the period drove the 23% reduction in our reinsurance assets. Trade receivables from brokered business was a major driver of the 132% growth in receivables from the full year position of 2018. All receivables from brokers are adequately backed by 30-day credit notes. Our year-to-date change in investment contract liabilities was by 8%, driven largely by the growth in the company's pure risk and investment-linked obligations during the period. Total assets was relatively flat with a growth of 2%, while our shareholders' funds grew by 3%. I will be handing over back to Bode Ojeniyi to take the concluding part of the presentation. Thank you very much.
Thank you, Sheyi. Ladies and gentlemen, we'll move on to slide 25, where we'll present the outlook as we see it. And I'll be presenting this under 4 headlines: financial, operational, sales, and people. On financials, we expect to continue to outperform the industry average GWP growth rate in line with our strategic growth expectations. We will continue to optimize efficiency and flexibility in our underwriting operations through business process automation across all service levels. We will consistently ensure financial discipline, effective risk-based pricing, and portfolio management across our business operations. Operational. Our digital division will continue to drive the implementation of the group's digital strategy, including digital marketing, channels management, and data analytics and intelligence. Our value propositions to customers will include excellent service delivery and competitive pricing. We will continue to improve on our risk assessment through advanced information analytics and reporting tools. We'll continue to expand our agency sales structure countrywide, solidifying our direct sales business strategy for top-line growth. we are furthering the full implementation of our bank assurance model in all major state capitals across the country. We have also restructured our corporate sales business growth with a strong desire to further deepen our market share, especially within the largely untapped commercial and SME market space. On people, we are committed to becoming a great place to work, building future champions, transforming economies, and investing in our communities. We will continue to engage and inspire our staff to become high performers with high potentials, having the right people in the right jobs, rewarding and developing them as well. We'll continue to inculcate the behaviors, culture, and innovation associated with leading customer experience providers. This brings us to the end of the session. Thank you everyone for listening in. The floor is now open for question and answer. Should you wish to ask a question, please unmute your phone or computer at this time and speak. We would like to ask that you indicate your name and your company as you ask questions. Thank you very much. Ladies and gentlemen, the floor is now open for questions and answers. Should you wish to ask a question, please unmute your phone or computer and speak. We'd like to ask that you please indicate your name and your company even as you ask questions. Thank you.
Good afternoon.
Good afternoon.
Good afternoon. My name is Dami. I'm calling from EY, Nigeria. I must say, very impressive performance in FY 2018. However, my question is that I have concerns around the growth in underwriting expenses. That will be on slide 10. In FY 2018, the analysis reveals it grew by 35%. I think that's quite significant, and chances are that it might erode any gains you're making on the top line. And it seems like the same trend is replicating itself in Q1 2019. Underwriting expenses has grown in Q1 by 191% year on year. Is there any reason for the jump in underwriting expenses in the experience you've had this year, this quarter, and also compared with FY 2018? Is there any trends?
Thank you very much, Dami from EY. Your concerns with respect to underwriting expenses are well noted, and what we'd like to say is in the year ended December 31, 2018, we got leadership of some major transactions within the oil and gas sector, and with this major transaction also came the increase underwriting expense, which grew by 35%, and the same thing is repeating itself even in the Q1 2019. We expect that the dividends of these expenses will begin to whittle down as we make the gains from the businesses. Does that answer your question, Dami?
Yes, it does. Thank you very much, sir.
Thank you very much. Ladies and gentlemen, the floor is still open for questions. Thank you.
Good afternoon, House. Hello.
Good afternoon.
Yes. Okay. I just wanted to be sure I could be heard. So my name is Lucien from
Yes.
EY. So my question actually goes around the regulatory perspective. So I mean, considering we take a market position as one of the leaders in the market, and our relationship with the regulators in terms of having some information with regards to regulatory activities, I wanted to find out. I mean, last year the regulator came up with some capitalization things. Of course, it doesn't affect WAPI because WAPI is capitalized or not. But do you really see any major change or development around the regulatory landscape in the insurance sector? Thank you. That's my question.
Okay, thank you, Nkem. At this point in time, we do not have specific details about the direction of the regulator regarding capitalization. But what we suspect is that there may just be a flat directive for capital increase, as against the tiering structure that was introduced last year and subsequently withdrawn. That's the speculation, but at this point in time, we don't have any specifics. I will not be able to speak to that beyond this point. Thank you.
Thank you for that. So my question is not just border of capitalization. I mean, in terms of any other major development or any trends. I mean, you look at talking about your underwriting and everything that's happened. So I'm just saying any major trend you see happening around based on your experience in the market and maybe some inflation impact. So that's the aspect I would actually be going to answer.
Thank you. At this point, there have been no major regulatory pronouncement regarding any underwriting or technical related issues beyond the directive that all insurance companies should adopt IFRS 9, even for the reporting of the 2018 accounts. And that's been a major development. And this is why the results of most insurance companies are coming out late, and now come out to even write to SEC to seek a waiver for extension of submission period for the quoted companies on the exchange. Beyond that, there have been no major developments of note that we're aware of. Thank you.
All right. Thank you very much for the clarification.
Thank you.
Thank you.
Thank you. You're welcome. Ladies and gentlemen, the floor is still open for more questions. Should you please wish to ask a question, please unmute your phone and computer and speak. And please be kind enough to indicate your name and company as you ask the question. Thank you. If there are no further questions, we would like to say thank you to everyone for participating today and for your continued interest in WAPIC Insurance PLC. We look forward to having you on board again when we have the next analyst conference. On behalf of my colleagues and myself, we say thank you and God bless. Do have a lovely day.